The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Is big tech back? Will David Solomon stand pat, and could TikTok finally be toast? Live from Bloomberg's world headquarters here in New York, I'm Romaine Boston.
I liked all those puns and the rhymes. Thank you. Happy Friday.
Happy Friday.
I'm Alex Steele. Happy Big Friday when it comes to the equity market. We have a monster rally underway here. I've been saying this since radio. It just feels like investors want to buy. That might sound silly, but that's what the price action looks like. You got the S&P up over 1%. Tech leading the way, up almost 2%. Consumer discretionary, led by Tesla, up over 2%. And S&P technology up by 1.6%. You cannot get a big enough bull market than this, Romaine.
A wild day, and it's kind of interesting to see stocks really shaking off what had been 2 straight weeks of losses, really getting their mojo back after it looked like the rally had actually permanently stalled. Maybe it was that break below the 50-day moving average last week. Maybe it was the encouraging inflation data this week, or maybe it's the quarterly bank reports that might foreshadow a strong earnings season overall in the weeks ahead. Of course, the elephant in the room, well, that is the return of Donald Trump to Washington, which becomes official with his inauguration on Monday. The jury is out on whether his policy wishes will be good or bad for stocks, but I want you to look closely at what's really being bought today and, quite frankly, on Wednesday as well. Discretionary stocks, tech stocks, as well as energy and materials names. We're going to put a pin in that and come back to that, of course, on Tuesday. But we're going to start this show on this Friday with the fight over TikTok. The Supreme Court upholding a law that requires China's ByteDance to sell the U.S. version of the social media platform by January 19th, that's Sunday, or face a ban. But here's the thing. There is a lifeline for the app should it choose to take it. Trump is reviewing the situation and potentially could suspend enforcement of that law. And according to media reports, there's a long line of investors out there who may actually be willing to buy up the U.S. assets of the company. That includes Elon Musk. That includes Amazon. That includes Oracle. And that also includes real estate mogul Frank McCourt.
Yeah, you had Morgan Stanley actually saying that maybe Amazon would be a good buyer for the company. So let's look into whether or not that's going to be realistic. Because one of the questions is, will ByteDance even sell? Remember, ByteDance has balked at that idea of selling. And the expected price tag could also be a barrier as well. Few companies or individuals could likely afford TikTok. And the question is, how much is it worth? Estimates are between $40 and $50 billion. Also, what part of TikTok are you buying? And if you're not buying that valuable algorithm from ByteDance, is it actually going to be worth that much money? A lot more questions than answers on this Friday as we look forward to the fate of TikTok. We want to welcome our Bloomberg television and radio audiences as we continue to discuss TikTok's future in America with the man who wants to buy the U.S. arm of the company. That's Frank McCourt Jr., founder of Project Liberty and executive chairman of McCourt Global. He joins us now. Frank, really good to get your perspective. You've made that formal bid for TikTok through Project Liberty. Do you know yet if TikTok is for sale?
Well, no, we're about to find out. And let's do a quick flyover here. Where are we? So the Supreme Court ruled 9-0 that TikTok must be either shut down or sold. They also, by the way, were very explicit about the national security threats of TikTok as it's currently designed. And this is a key point because the legislation that they upheld was very clear that this is a national security threat. The Supreme Court just validated that and reaffirmed that. So if it's sold, because the choice is ban or sell, if it's sold, whoever buys it has to fulfill the criteria that the Supreme Court laid out. You need to disentangle the user base and the data from the Chinese technology. Project Liberty has a clean tech stack to onboard the user base and the data and meet the criteria laid out by the Supreme Court.
Frank, do you have I'm sure you have an idea of how much you would pay for it, but can you help me understand how you came to a valuation?
Yeah, well, you know it's worth something. And on the other hand, we know what the entire company is worth on the secondary market, what people are selling shares for now. So you have bookends. And then we know that U.S. TikTok is somewhere around 8%, 10% of the entire platform. So you have an ability there to be able to bookend or frame the valuation. And of course, we've done extensive modeling to sharpen that. Now, the one big if is what exactly are they selling? Are they selling the brand or not? Which of the assets are they selling? Of course, the user base and the data are what's critical to us. But what we know for sure is they're not selling the algorithm. And that is key. If you come forward with all the money in the world and say, I'll buy US TikTok, but I need the algorithm, you're not going to get it because the legislation won't allow it. And the Supreme Court upheld that legislation and said any buyer must, to be eligible, must not use or rely on any of the Chinese technology. That is really fundamental to this transaction. So, of course, it's about the money, but it's about having the technology to onboard the user base and the data without relying on the Chinese technology.
Frank, Romain here. I am curious, though, about China's involvement in this. They obviously have a big say in whether this gets sold and potentially who it gets sold to. Are you worried at all about your bid, and I'm specifically speaking about your potential bid for this company, that it would satisfy whatever China's looking for? And I don't know, do you know what China's looking for out of this?
Well, I know what China is for sure clear about. They're not letting the algorithm go, right? They've said this is part of Chinese government property. Part of so the IP is something that they have a white knuckle grip on. And by the way, clear, and any buyer is not going to get that anyway because the legislation won't allow it. So I think the win here for China is a buyer coming forward that can comply with what China has said they're not selling and make a deal for what they might be willing to sell. And Romain, we'll know shortly whether or not ByteDance is going to change their mind now that they've exhausted their legal remedies. And I've said from the beginning that the government would win the case, the legislation would be upheld, and when that happened, US TikTok would be for sale without the algorithm. So let's see. We now know that the first of those is correct, that the Supreme Court has upheld the government's position, and we'll now see if ByteDance changes its mind and wants to enter into conversations about a deal. Why not? Why not sell it for something rather than get nothing and just shut it down?
So, Frank, in terms of trying to put a value on this, and I know it's going to take some time to hear from those folks before you can put a true value, do you worry at all about potential attrition of users? That with all this talk about a ban, there's been a lot of anecdotal evidence of users, power users, migrating to other social media platforms in anticipation of a ban. Does that worry you at all that you might be left with an asset that is just seeing too many people flee?
Absolutely. I think it's one of the big risks here, and which is why we're hoping that the app stays lit up. And by the way, President Biden and President-elect Trump have both said they want to see the app lit up. They don't want to see it banned. The key here is, in order for that to happen and the 90 days to kick in, there needs to be a viable buy. There needs to be a deal. And for a buyer to be viable, they need to have the technology stack to move the user base and the data over to without relying on the Chinese technology. So it's more than your typical business deal, highest bidder wins. This is a complicated transaction, and at the heart of it is protecting American citizens. Our technology does that, and then putting forward a respectable bid for the U.S. TikTok assets without the Chinese technology.
Frank, there is a conversation that circulates that potentially TikTok is getting wrapped into trade conversations when it comes to China. Have you spoken to anyone in the Trump administration about this?
Yeah, we have. And you know, Kevin O'Leary has joined our bid, and Kevin went to Mar-a-Lago. We spoke to President-elect Trump, and President-elect Trump encouraged us to carry on. And I suspect that this will be a broader conversation that President-elect Trump will have with President Xi. That said, we're still back to square one about how do you buy U.S. TikTok, keep it lit up, prevent a ban, and comply with the legislation and the Supreme Court's ruling. And so I'm sure there'll be wheeling and dealing going on, and there always is. But the point is, there are some fundamental criteria necessary to make the deal. And that's the key. And that's where Project Liberty comes in, because we've been building this alternative tech stack for the last 5 years. We're in the right place at the right time.
Frank, have you been in contact at all with the Trump administration or the Trump transition?
Yes, as I just mentioned, Kevin, who's my partner on this, has gone to Mar-a-Lago like 2 weekends in a row now to be in touch with all of the players there, the president-elect himself, and also his key team. So we from the very outset here wanted to make sure that the Biden administration and the incoming Trump administration, and of course, both President Biden and President-elect Trump, knew exactly what we were up to. We don't want any surprises here. We want to help. We want to be part of the solution to keep TikTok lit up, avoid the ban. And that's what President Biden and President-elect Trump want as well. So let's make a deal. Let's get this done. We have the solution.
All right. Well, the president-elect has said he needs time to review this. Of course, he's inaugurated on Monday. Frank, we're going to catch up with you sometime soon in the future once we get more clarity on what the potential valuation could be. Frank McCourt Jr., the founder of Project Liberty and executive chairman of McCourt Global, who has said that he would bid for those U.S. TikTok assets along with Kevin O'Leary and some other investors should he be given the chance. We do want to focus a little bit more on the legal perspective on that TikTok ruling. And turn now to the ACLU, which has actually taken a stand on this issue. The organization saying that the ruling today by the Supreme Court will actually endanger the constitutional rights of every American to speak and receive information online. Patrick Toomey, Deputy Director for the ACLU National Security Project, Ashley Gorski, Senior Staff Attorney at the ACLU National Security Project, join us right now. I'll start with you, Patrick, because kind of explain the free speech issue, because when I hear the word free speech being restricted, I look around, there's 100 social media sites out there. I went and counted, at least 15 of them have 100 million plus users or more. If we get rid of one of those, how is my free speech restricted?
Well, TikTok is a unique forum for expression online, and some of the conversations seem to assume that users can simply migrate to a new platform. But as we were just hearing, another app or even TikTok, if its US components are sold, wouldn't have the same algorithm. And both creators who rely on the platform for their livelihood and who communicate about politics, entertainment, education, and users who have, follow voices from around the world to learn about natural disasters, social upheavals, wars, would not be able to communicate with those same communities that they've found on the platform.
So, Ashley, I am curious, though. I mean, the decision that sort of put all this in motion wasn't just made willy-nilly. It wasn't like, oh, we hate TikTok, let's shut it down. There were national security concerns, and we can get into the legitimacy of those concerns later. But there were national security concerns about the Chinese government's either involvement in ByteDance or at least its oversight of ByteDance. Does that not in and of itself, from a legal perspective here in the U.S., does that not outweigh some of the First Amendment concerns?
No, it doesn't. The First Amendment applies in the national security context the same as any other context. And when the government is discriminating against speech on the basis of its content or viewpoint, it has to satisfy a very high standard under the First Amendment for that restriction to survive. And here, the government didn't satisfy that standard because at bottom, its national security concerns are speculative. It admitted in court there is no evidence that the Chinese government is covertly manipulating TikTok's content in the United States. There's no evidence that the Chinese government is accessing Americans' data through TikTok in the United States. And given that lack of evidence, the government just has not come close to meeting the standard that it needed to meet under the First Amendment. And today's decision is a real disappointment for that reason.
It did seem, though, that there was secret evidence that wasn't even unveiled in that case. But Ashley, the counter to that is that foreign companies shouldn't have free speech rights in the U.S., full stop.
Going to the secret evidence point, the Supreme Court was very clear that its decision was not relying on that secret evidence in any way, shape, or form, because that secret evidence presents a separate set of due process concerns. And I think it's very clear there's no smoking gun in the secret evidence. And if the smoking gun were there, the Supreme Court would have done more to rely on it. And then separately, TikTok Inc. is a U.S. company. it has American users. Those American users and TikTok have First Amendment rights. This is not just about the speech of the Chinese government. It's about the First Amendment right of Americans to receive information, to speak on the platform of their choice. And the Supreme Court has been very clear. Americans have a right constitutionally to receive information, including information from abroad, and even including foreign propaganda. The First Amendment contemplates that Americans will decide for themselves in the marketplace of ideas which ideas to accept and which ones to reject.
So, Patrick, I think it gets so thorny, though, because it's about the algorithm. It's about the app, not the content. And how do you put free speech together with an algorithm?
Well, the Supreme Court ruled just last term that even tech companies have a First Amendment right to curate the content that appears on their platform. And that's one of the things that makes TikTok unique. Again, its algorithm and the way in which it decides what content to show users. And so there's a relationship there between TikTok, the US entity, and the users in the United States who have flocked to the platform precisely because the algorithm that it relies on gives them content in a way that they love and that they love to speak on, that they love to produce videos about, all kinds of different aspects of their lives. And so that is really the core of the First Amendment concern. It's not just TikTok, the company. It is those 170 million people here in the US who rely on TikTok to get information and to share and to speak every day.
All right, guys, thanks a lot. We really appreciate it. Thank you for your time today, Patrick Toomey and Ashley Gorski of the ACLU National Security Project. And speaking of, here's one of them right now. I want to bring in a creator who's among the 170 million users in the U.S. to be impacted by the court's decision. Joining us now is Rachel Grae. She's a recording artist who has created her own app in the wake of the ban to sustain her connection with her fans. Rachel, TikTok is very near and dear to your heart. I mean, you were on becoming a pop star on TikTok. Could you have done that in your life without TikTok?
I don't think I would have been able to, no.
So without TikTok, how do you think you're going to be managing here? What are you losing by migrating to your own website?
I mean, you just have to pivot and hope that you could bring as many people along as possible. But I think the most important thing is to just continue posting on all other platforms. I did make my own app. It's Rachel Grae on the App Store, just in case any of this happens, just to have that control over my platform and the people supporting me is, I think, one of the smartest things I could have done.
Well, can you expound on that a little bit? Because we've talked with creators in the past, and some of them were only on TikTok, and that was part of the fear, was how do you sort of take that success and translate it to another platform? And then you have other creators that have found a way to, even before all of this drama surrounding the TikTok legality, had already sort of spread themselves around other social media platforms. How difficult, or maybe how easy, is that to do?
I think it depends on how you think of it. For example, Vine left and everybody had to kind of pivot to a different app. Instagram has always stayed. YouTube has always stayed. There's a lot of apps being spoken about as being the next one up. So I think it's just having that open mindset of just using the platform TikTok and putting all of the videos that you've made onto the other apps as well. So that's what I've been doing, is just spreading all of my videos onto other platforms as well so that other people could find it.
Rachel, what do you lose without TikTok then? Because you got ahead of this in some ways.
Yeah, I've built a family on TikTok. I feel like I have a huge community there. Not all of my other platforms have the same exact following, so I feel like I'm losing the reach that I had. I had so many people that I met through TikTok, friends, a lot of people from different areas like Australia, the UK, everywhere. I feel like it brought a lot of people together. So I think that sense of community is going to be gone for a little bit.
If you have sort of say a budding singer, another Rachel Grae out there who doesn't necessarily have the following or the success that you have, would you recommend that she or he start out on TikTok or maybe somewhere else?
Well, now I'd say you should start everywhere. I know that sounds a little intimidating, but just making one video and pressing post on a few platforms at the same time can be the smartest thing that you could do, and not relying on just one app to give you that platform is the smartest thing that I could recommend.
Yeah, I mean, that makes sense. And it's not as easy as you said. Like, it's not just you're shifting your family over. You have to rebuild it, and that's quite difficult. What was the biggest hurdle in doing that? because something that's so unique about TikTok is that algorithm that's so helpful. So what was your biggest hurdle in trying to move that family elsewhere?
Right. I think the biggest hurdle is that the other platforms don't spread to every single person that you would normally reach, where with TikTok, you're posting and it's being spread to everybody that has the common interest. I know other platforms are trying to start becoming more like that in that way because they've seen the success. But I think platforms that we're using also have to be more mindful of the fact that that's going to be gone and people are going to be craving that sort of big reach that other platforms don't necessarily give yet.
I am curious, Rachel. We have spoken with Frank McCourt. He's an investor who's interested in buying the U.S. assets should the government allow him to do that. I asked him a question about attrition, the idea that a lot of people are already leaving TikTok in anticipation that it gets banned. Suppose that it is saved. Do you think those people will come back, or have they lost too many folks already?
I think everybody will come back. I think everybody's trying to search for the next thing to be safe. But if TikTok's there, I think everybody's staying.
All right, Rachel, really appreciate you taking time for us today. Rachel Grae, a recording artist who, of course, has more than 1 million followers on TikTok. You know, Alex, she's also going to be, I was just looking, in New York next month performing at the Mercury Lounge if you are so inclined to see her. And I don't know, you're not a TikTok user, are you?
No.
No. Yeah, I think, you know, I have an account. I don't really use it at all, but I'm on there.
But what I was so interested in, so Norma Melinda co-hosted radio with me earlier. She's the young folk, and she was saying that she uses it as Google. Like that's how she gets trip recommendations, and how she plans trips, how she gets restaurant recipe recommendations. I was like, wow, mind blown. Yeah,
my teenager does the same thing, and I've heard from a lot of other kids that is the primary source of a lot of their information. Not like us, we're still, you know, typing around, Googling. All right, we do want to turn back now, of course, to what's been going on in the markets themselves. We are sitting on a pretty massive rally on a weekly basis. In fact, the strongest rally for the broader market going back to just before the election. And a big part of that reason is actually financials. The KBW Bank Index up 8% on the week. This after they closed out 2024 with record profits topping $100 billion for the second time. That's the big banks. They've already reported. Now we look ahead to the regional banks to see, well, what they can put on the table. Betsy Graseck joins us right now, Global Head of Banks and Diversified Finance Research at Morgan Stanley. And Betsy, before we get to the regional banks, let's start off with this phenomenal quarter for the big banks. And I feel like every quarter we head into this into earnings season and we say this is the quarter that we finally see the big banks falter, and they really didn't.
Well, I don't enter every quarter thinking that, Romaine, have to tell you. But I did expect something like what we got last quarter in October at some point this year. I didn't realize it would be as quickly as we got it. What am I talking about? This fourth quarter 24 earnings just reported this week by the big banks is another beat and raise quarter. We had that in October. It was very exciting, and we got it again in January.
What's fueling that, Betsy? Is it economic conditions? Is it the diversification of those banks, meaning one unit can do well even and another one could do bad? What's sort of the mix that has led them to have these beats quarter after quarter?
I think it boils down this quarter to three key things. Number one is capital markets activity is just beginning to accelerate. And we saw that come through in size this quarter. We have investment banking fees up 83% year on year in the group that I cover. And that's led by equity capital markets at about 83%. And then you've got M&A at the other side at 18 and fixed income and debt underwriting, for example, in the middle. So you have this capital markets acceleration, which is feeding into revenues coming through better than expected. And as capital markets activity, underwriting debt and equity occurs, you have positive spillover effect to the trading environment as well. So equity trading, fixed income trading, what most of the banks like to call markets, also had a very strong in the 30% range year on year. Now, look, part of that this year was also the election, the volatility associated with the election in the fourth quarter was a bit of a helpful component there. But in addition, as we look forward for the rest of the year, we do anticipate a continued improvement in capital markets activity. And that, again, should help spill over into trading. So
Betsy,
that's one.
Yeah. But Betsy, it's a different story when it comes to the big regionals like a PNC or US Bank, for example. They need that net interest income to really grow. They need that loan demand. It doesn't feel like we're seeing it to the same extent.
So great question, Alex. And then I was just going to go to my second reason why the banks are outperforming this quarter is the yield curve, right? The yield curve, as you all know, steepened quite a bit over the last quarter. And banks benefit from a steeper curve. So what we got from a wide variety of banks, including some of the larger super regionals like USB and Truist, like mentioned, and others, is that we got net interest income coming in a little better than expected. And importantly, January is the outlook quarter. So we got the guides for 2025, what boards are approving, managements, to go after. And so the guides, on average, for most of my banks, had net interest income that was at the high end of the expectation range, and in a couple of cases, a little above. So as I think about rolling into next week and we get more regional banks, my colleague Manan Gosalia, who covers the regional banks, he's been pretty busy this week too. And that's where you're going to see some potential opportunity is in the steeper curve. But to your point, yes, loan growth is the ticket, right? Loan growth to regional banks is capital market to large cap banks.
Yes.
And that loan growth has not yet really started to accelerate. We here at Morgan Stanley do anticipate in our research team, Manan and I, we do anticipate that we'll get some improvement in that loan growth as we go through the year. Why? Well, first is Trump proposals will, should get known. So tariffs, immigration, taxes.
Betsy.
And
Sorry, we have to cut you off because we're headed to a hard break. We're going to get you back, particularly after the credit card companies report. We'll break it down more. Betsy Graseck at Morgan Stanley. This is Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. We are off the highs of the session, but it's still a pretty powerful rally on this Friday, headed into a whole new world.
A whole new world. But I get to you, I was asking a lot of people today sort of what was driving the rally. Was this kind of reignation of the Trump trade? Was it something else? And a lot of people said it really just came down to fundamentals, right? You talk about the earnings that we got out of the banks, and maybe that presages something good out of the rest of the companies. But of course, that still ties back to what really drives this economy, and that's consumer spending.
Consumer spending and services, and where that really sits. Well, Bank of America Institute says the U.S. consumer went all out towards the end of the 2024 shopping season, driven in part by a big boost in consumer confidence. So we want to get a little perspective about how those tariffs that could come in could impact that consumer spending. David Tinsley is senior economist at Bank of America Institute. He joins us now. David, to that point, do we have any sense if consumers are front-running any tariffs and buying at the end of the fourth quarter?
Well, it's really interesting because what consumers are saying doesn't seem to us in our Bank of America data what consumers are really doing. So what consumers are telling the Michigan survey is that now's a great time to buy consumer durables. And the reason they're saying that in the survey details is because they think prices are going to stay high, which, has a kind of feeling that maybe they're worrying either just about general inflation or tariffs. But in Bank of America data, when we look at, in our credit and debit card data, what people are spending on, and we look at the kind of high value consumer durable spending, that's not really increasing as a share. It's pretty much 20% of the basket. It was in 24. Was in 23. So at the moment, I think the story of strong spending in December is a genuine story, if you like. It's not necessarily front running.
That's encouraging. Do we have an idea of what happens, though, if we get tariffs and price increases? I guess the question is, how price sensitive are these consumers right now?
Yeah, well, I mean, they're heading into this year in good stead. So in our card data, as you were saying in your leading we had a very strong end. Spending was up 2.2% in credit and debit card spending, which was the strongest year-on-year growth over the year, second strongest. Only February, with the extra day due to leap year, beat that year-on-year. So consumers have momentum going into 25. So I think, and it has to be said, a lot of that momentum, of course, is labour market. So in our data, when we look at the wages being paid into people's accounts, they're still showing growth of around 3%. So, sure, I guess the overall policy landscape's quite uncertain, and you can't peer too far in the future without quite a lot of mist. But right at the start of 2025, the consumer is in good shape.
David, as you sort of track this data, and particularly going forward, what do you think is going to be most important to keep an eye on? Is it the confidence of consumers, or is it what is actually tangible, meaning what's in their bank account, what their income levels are, et cetera?
Well, I think it's probably the latter. I mean, obviously, we have an advantage in our hard data. We have 69 million customers, so we get real-time hard data on what consumers are doing. Now, you've got to remember that consumer spending was very strong in 23 and 24, particularly on services. But consumers have been feeling beat up and been telling the surveys, they're much less confident than they were just before the pandemic. So in a sense, if, the consumers haven't necessarily been following through with those negative survey intentions in terms of spending last year. So even if consumers' confidence flips up in 25, I'd wait to actually see the hard numbers on the ground from us that would confirm that pickup.
So what sort of changes that at all? And the reason why I ask, we've talked so much about the potential disruptions from the new administration coming in. There's been a lot of talk about supply chain disruptions. It could be inflationary here. What sort of knocks that confidence off a peg?
Well, at the end of the day, it's going to be the labour market. I mean, as I was saying, wages are growing at 3% year on year across pretty much all the income cohorts. Over the last few years, consumers have had a sort of tailwind from money in the bank, excess savings, if you like, and also from the fact that they've had a margin to borrow on their credit cards relative to their limits. And that's added a kind of second wind to the overall labour market story. Those tailwinds are declining somewhat, ameliorating.
Yeah.
And really, so the consumer spending more and more is a labour market story, which is in very good shape at the moment. So again, the momentum looks pretty good at the start of the year.
All right, David, great stuff. David Tinsley, senior economist over at the Bank of America Institute. A closer look here at economic conditions and consumer confidence as we head into a new era with Trump 2.0 and potentially Tariffs 2.0. It's a big topic of conversation on Wall Street, with the number of mentions reaching a high last month. From an investor's point of view, we want to bring in Elias Sabo. He's CEO and partner over at Compass Diversified, also known as CODI, which provides public shareholders an opportunity to own and invest in middle market businesses, brands such as Primaloft, Sterno, Lugano, and quite a few others. Elias, you are tapped into what the consumer is feeling. How confident are you in the confidence of consumers?
Yeah. Good afternoon, Raymond. We have seen consumer strength throughout the entirety of 2024. We saw at the end of 24, especially in December, a real pickup in consumer spending across all of our portfolio. And I listened to your earlier guest say all income cohorts are starting to spend. We saw that as well. In the beginning part of 24, it was much more at the top of the income ladder that people were spending, and now it seems to have broadened out. So post-election, we've seen a pickup coming into January. That continues, and our expectations are for the current year, absent some, kind of policy changes that could derail the economy, we see consumer spending continuing to be really strong.
Okay, that's the demand side. I do want to talk a little bit here about your own supply issues, supply chain issues, if you will. Have you made any changes in anticipation of maybe additional tariffs or other disruptions to your supply chain that could affect how your products get to market?
Yeah, clearly. And as I remind people, we had a Trump 1.0 presidency. And during that time, if you were listening, I think everybody as a CEO decided we needed to diversify not just our supply base by the vendor, but also by the country and by region. And so we have done a very good job of moving a lot of our supply to secondary sourcing outside of China. And as a result, we feel that if the tariffs are China-centric, although there will be some disruption to get the rest of our production into neighboring countries, we have a pathway to, with minimal financial issues, be able to move all of our production. Now, if tariffs are blanket and it's not just China-centric, and I think there's been talk about, kind of a low level of tariff overall, and then there will be a major tariff in China, that's going to have to be absorbed across the supply chain. And I would imagine that, consumers are going to have to pay quite a bit more as price, kind of has to reflect the increase in costs that we have due to these tariffs.
Yeah, so Elias, can you walk me through the math, just, hypothetical math? If it's a blanket tariff, like 10% increased, is all of that going to the consumer in your world, or how do you think about that?
Yeah, Alex, if you think about the margin profile and say, our average gross margin is about 60% across the portfolio, 50 to 60%, one could say that a 10% increase in COGS is going to represent sort of a 4 to 5% increase necessary in final sales price in order for us to recover it. I think one of the questions that is going to exist is, does the dollar strengthen as a result, and therefore does the vendor, eat some of the tariff costs? Are there other policy considerations that happen at the same time? For example, taxes that could come down and offset some of these costs. So I think if you look at a 10% across the board tariff, I would say for us, it feels like the upper band of consumer push is going to be about 4 to 5% on inflation, but hopefully there's some offsets that can make that more moderate.
Elias, as Raymond was pointing out, you have a portfolio of companies in many different sectors, and I'm wondering, the whole goal of the tariffs is to onshore manufacturing or onshore retailing. It's to onshore everything. Would you do that in your different businesses?
It's just not feasible, Alex. And that's where the notion of tariffs is so far off. I understand wanting to get better negotiating leverage so that we can open up markets for U.S. companies in foreign countries in the same way that those countries have open markets to the U.S. But to think we're going to put tariffs in place and bring production back to the United States, it's just a silly notion. We don't have the skill set to be able to do that resides in the U.S. We don't have the infrastructure to be able to do that. So to think any of this is coming back is just not going to happen.
I am curious, though. We talk about this idea of, it may not happen, but we're certainly going to be challenged on that front, at least if you believe what the president said on the campaign trail. And I guess it gets to the question of, should CEOs, this isn't necessarily just a question for Compass, but should CEOs sort of be making those changes in advance in anticipation for it, or do you wait until you actually see more concrete policies and concrete policy effects before you make those changes? And if so, would that be too late?
Yeah, and that's one of the big questions, is how anticipatory can you be when some of this just could be negotiating posture? And there are costs associated with moving too quickly. Moving out of China, for example, has financial costs because neighboring regions don't have as efficient of an infrastructure built up for a lot of the production that we're sourcing. So I think one of the problems that you look at here, Romaine, is, if these tariffs go into effect, you want to be in position to move really quickly. But if you move too quickly, you can put yourself at a cost disadvantage if, in fact, they don't come into effect. So what we have done is we've worked with a lot of our vendors who have, for example, China factories, and then they have moved into neighboring countries because they, too, are afraid of possible ramifications of tariffs that are implemented against China that are disproportionate to the rest of the world. So our strategy has been sort of to position for and have all of the operational, kind of capabilities in place to move very quickly if tariffs are to be implemented and the policy is different across country, but not yet to move too much of the production so that we don't get over our skis.
All right, Elias, good to catch up. Thanks a lot, Elias Sabo, CEO and partner at Compass Diversified. We appreciate that. Let's get back to the markets here. We're off the highs of the session, but the S&P really led up by Intel. That stock still soaring on reports that global foundries may look to acquire the struggling chip maker. Joining us now for more is Kujan Sobhani of Bloomberg Intelligence. Who do you think, in your modeling, would be the best buyer for Intel?
You know, it's very hard to find the ideal buyer for Intel. Acquisition of this company in its entirety is going to be very hard, and from an execution perspective, from a financial perspective, regulatory perspective, and more important, what do you do after you acquire this? I think that anyone who acquires this has to divestiture size different segments, because running this as a whole, we have seen, has not worked out. So it's really hard to pinpoint a single ideal buyer at this point.
This gets to this idea, though, and there have been a lot of names floated. We don't have to go through too much speculation, but it gets to this idea that, at least right now, it seems like the initial read on Wall Street, this is almost unbuyable, that at least the public, the folks that we know in the public who would have the resources to do this, maybe don't really have the gumption to do what you just said, Kujan.
Yeah, and I mean, at best, it has to be sort of a multi-buyer deal where, you bring in a couple of companies who are interested in certain specific assets, and then you bring on private equity type of investors who give financial support. And all of this, by the way, has to be brokered in a way by the government. Like, you cannot do this without the government support, because from a regulatory perspective, there's no way this gets done if it is a single entity takeover.
Kujan, how ugly is it going to be for Intel for how long?
I mean, look, they have been doing what they should be doing to improve. It's a pretty large ship in terms of the business. They have the revenues, which is not easy to turn around. They have at CES, they announced a couple of new product and business lineups. Based on our latest discussions with them, they seem to be going on the path, on the right path and the right execution. But this, like I said, it won't be a quick turnaround story. This does require patience, and through the path, there might be some hurdles that you have to live through.
Well, this gets to the question, too, about leadership at the company. I mean, what is the status right now of the CEO search? And, I mean, is this kind of putting the cart before the horse?
Yeah, I mean, look, they have appointed the co-interim CEOs, who have been with the company and working with Pat very closely, and the direction has not changed. So that's good for this company right now, as it is looking for its permanent new leader. And we think that search might come to an end soon, and we might hear something sooner, at least maybe in the next quarter or so.
All right, Kujan Sobhani, the best of Bloomberg Intelligence, a closer look at some of those rumors surrounding Intel that maybe it could be up for grabs. Those shares up about 9%. And Alex, it raises a lot of questions. First of all, they're searching for a new CEO. If you're an external candidate, are you going to walk into this with that type of speculation swirling around?
I mean, Larry Culp went to GE. Things have happened, but I don't know. I genuinely don't know. I also don't know who that name would be that would come in and take that. Like, Larry Culp made a lot of sense in the industrial world for that.
Absolutely. And then now you got names, just random names being floated around. Elon Musk, Citigroup out with a note saying that that's preposterous.
Elon's busy. He's got too much to do.
Last time I heard, he's got a lot of other things that he's doing as well. Nevertheless, Intel having a great day. Believe it or not, it's actually not the best performer out there, at least among the major stocks, as we continue to see stocks rally pretty hard here on this Friday afternoon, setting up for its first week of gains in 3. Dana Doria, CO-CIO with Envestnet, going to be breaking it all down for us next on The Close.
The one big if is, what exactly are they selling? Are they selling the brand or not? Which of the assets are they selling? Of course, the user base and the data are what's critical to us. But what we know for sure is they're not selling the algorithm, and that is key.
Frank McCourt Jr. there, of course, made a fortune in real estate, used to own the LA Dodgers, and maybe, Alex, could he potentially own TikTok? Of course, we started off the show talking about that Supreme Court ruling and maybe some of the investors who would be willing to buy those U.S. assets. I was taking, to kind of keep this focus on markets, I was trying to take a closer look at whether the other social media stocks are moving on this.
Not really.
Kind of a mixed bag here. You had Meta up, Snap was down, Pins was up by marginally.
Yeah, but speaking of The rally is still pretty strong. We're off the highs, though, but still, NASDAQ 100 up by 1.7%, right? You got the Mag 7 really leading it, even the Russell and the mid-caps participating as well. And on what news, dare I ask? Like industrial production?
Yeah.
Like that's what we
don't
got.
ask, Alex. Just don't look the gift horse in its mouth. And we talk about the big movers. Yeah, the Mag 7 doing their bidding. The biggest mover in the S&P, surprise, Intel up 9%. And just a few seconds ago, we had some news crossing on Walgreens, and those shares actually now dipping into the red.
Yes, apparently the DOJ is filing a nationwide suit versus Walgreens, saying that the company dispensed unlawful prescriptions, and they could face up to $81,000 per fine for each prescription. So the news from D.C. on that end coming fast and furious.
And it feels like news out of D.C. is going to be a big driver of market action over the next few weeks and months. And I guess if you want to put a peg on it, call it January 20th, Monday, when the new president is inaugurated, a president who said that he may come out with as many as 100 executive orders in his first week of office. He's not wasting any time here, and that could have a big impact on the markets. Dana Doria joins us right now, co-CIO with Envestnet, as we count you down to the close here on this Friday afternoon with just 8 minutes to go. Dana, great to have you. You see a reigniting, if you will, of the market rally. I guess the big question, I don't know if you can answer it, is sort of why, and more importantly, does it last?
Well, I certainly think we're still riding a bit of the high that we had from that inflation report, right? So inflation coming in better than expected, and immediately the market impacting on, the anticipated rate cuts, going from kind of the 1-ish territory to now back to 1 to 2. We can't help but sort of take any bit of good news and extrapolate that we're going to get rate cuts out of it, it seems. But I think that's, that's certainly working its way into this. Now, I think, generally speaking, the market and what we hear from economists and, all the investment managers kind of that we're working with is people are pretty still optimistic about the market as we move into the year, right? There's not, unemployment picture stays strong. Inflation and the potential for Fed rate cuts to not materialize, we kind of saw that worked in already, and there is an expectation that this administration will kind of run it hot. So I think folks are, still pretty confident about the coming year.
I am curious about the interplay of rates. We talk about the sort of resumption of the rally. We should also point out that big sell-off that we saw in treasuries has abated, at least for right now. And it raises the question of how much yields are going to play a factor, or I guess how high yields need to be to play a factor in equity returns.
Yeah, that number moves around, doesn't it? In terms of just what folks think, like, is it 4.5? Is it 5? I do think there is a number at which the equity markets choke a little bit, obviously. And we know that higher rates are not good for multiples. We also know that we're living in an equity market where multiples are pretty high, right? In the US market in particular. Now, of course, is coming from the very concentrated end, but at the same time, even across the index, it means that we have pretty high multiples. And so I think, there's some number, knowing exactly what that is, I think we're not, we're clearly not there. And, I think the market in general now is more susceptible to the fact that valuations are pretty high. And there's, we retain this kind of price to perfection kind of outlook, particularly on the very big stocks.
How interested, Dana, are investors, your clients right now, in Mag 7 versus the other 493 stocks?
It's interesting, right? I think it's a tracking error consideration. And when I say investors, really, I would point to the advisors who are actually allocating those assets, right? So we work with 110,000 advisors on the platform. They're all the ones who are actually kind of making the decisions, working with their investor base. If you're in a passive investment, which a lot of folks are oriented to, you obviously have a huge slug of Mag 7. But I think what's interesting too is that even on the active side, traditionally, we've seen a lot of closet indexing or benchmark hugging, because it's really hard to take tracking error to the benchmark and then get completely, kind of annihilated. And of course, diversification requirements, if you want to be diversified, you can't actually have all that concentration in the Mag 7.
Right.
So active managers who've moved away from that and advisors who've moved away from that have felt kind of the pinch of that. So I think the tracking error is kind of low, which means they end up in the Mag 7.
Right. I love that closet indexing. So to that point, though, then diversification is going to be very tricky. How much do you think we're going to see in the private market to kind of offset that rush to the Mag 7?
Yeah, the private markets are no question alternatives managers coming down market to sort of the not only the high net worth but the mass affluent. We're seeing just a proliferation now in discussion and creation of vehicles. Interval funds is 100% a vehicle that we're expecting to see a lot of play on the platform over time. Private credit is the place that you're seeing a lot of activity, but I expect private equity as well in the attempt to kind of get some, return premium over and above what you get in public market equities. You're going to see a lot of innovation in that space coming down the pike.
Dana, one last question here, and this really has to do with the idea of, sort of American exceptionalism with regards to the financial markets versus the rest of the world, and whether there is any case at all for any sort of meaningful allocation outside of U.S. stocks.
Well, look, because of the run up in U.S. stocks over the last several years, even if I'm passive at this point, I've got, 70-odd% in U.S. And so having the diversification of, even if I want to just take the global market cap weight, having some of the international at that weight still makes a lot of sense, right? I mean, it's just, even at a huge point spread, even the best team, right, is not going to perform to that point spread. And it's the same with stocks, that at some point valuations do matter. And so, unless AI and when AI, strikes and really raises and just continues to raise the capabilities of those firms, it makes some sense to diversify absolutely into other areas of the market like small caps, and like international stocks.
Dana Doria over at Envestnet helping us count you down to the close. Those closing bells 2.5 minutes away. Your S&P right now 59.97 and change, scratching 6,000, up 1% on the day, Alex.
Yeah, and taking a look at the intensity of the rally on, I'm going to call it no news. It just feels like the jam was to buy into this Friday.
The one outlier is Dow Transports. A full breakdown starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you to that closing bell, a global simulcast. It starts now. Jess Menton in today for Scarlet Fu, Carol Masser and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms here on a phenomenal day for markets. I should really say a phenomenal week for markets here. Carol, we thought the rally was over. We got a reminder today and on Wednesday, it's still alive and well.
I was just playing around with my Bloomberg and just looking at for the week overall. You're talking about, 3% gains in the S&P and the NASDAQ 100 this week. And the names that you guys always like to point out, Romaine, you in particular, those small caps up about 4% for the week overall. So, wow, that's pretty impressive. That's definitely a much more bullish trade that we've seen in a while.
I'm impressed, Carol.
Yeah.
Bitcoin, not impressed. For the week, up more than 10%. We're actually above $104,000 per Bitcoin.
Wow.
Party house. Confetti.
Everyone's partying. Everyone's buying.
I wanted to bring up what's happening actually with the equal weight index because Alex was just mentioning this in the last segment, but it's actually up 4% for the week. So this is its best week since the election. So even though obviously we saw Mag 7 kind of leading the way today, you still had other corners in the market broadening out.
And here's my question. So I was looking at Fastenal earnings that came out, right?
Oh, yeah.
They weren't great. And the stock responded in kind. And then all of a sudden by like 10 a.m. it bottomed and then it's closing up by 2%. Is that it could have been worse, or did they actually say something materially on their call?
Well, it's kind of interesting, too, because we were talking about big tech and all this stuff today. But like I said, on a weekly basis, it's materials and energies and all that companies, the outperformance of the Russell relative to the S&P on a weekly basis. Of course, we've been here before. We've talked about how this was sort of the turning point for small caps. And of course, here we are back at square one. Anyway, we do get the closing bells here in New York with the clapping and cheering on this Friday afternoon. The Dow Jones Industrial Average up more than 300 points, or roughly about 0.8%, and on a weekly basis up 4%. The S&P up 1% on the day and roughly about 3% on the week. The NASDAQ Composite, and I should point out the S&P just closing shy of that 6,000 mark. The NASDAQ Composite up about 291 points or 1.5%. And take a look at the Russell 2000, only up 0.4%, but it did on a weekly basis outperformed the S&P.
All right, back to the S&P, or staying with the S&P, I should say.
Yeah, because I just mentioned it.
She was totally listening.
Oh man, it's Friday. All right, looking at what Romain just mentioned, the S&P 500, 340 names to the upside, guys, 159 to the downside.
And guys, all of the top 3 sectors leading, with you're looking at that IMAC function, are the ones that house the Magnificent Seven. So discretionary, technology, communication services leading the way higher. But on a weekly basis, energy, financials, and materials were the best sectors of the week.
All right, Intel, your number one gainer. Check it out, guys. In the S&P 500 and the NASDAQ 100, up pretty much closing just off its best levels of the session. Still a 9.2% gain. This is after a report on a technology news site that said the chipmaker is an acquisition target. We kind of know that. Semi-accurate. A tech-focused newsletter said it had read an email about a company trying to acquire Intel whole, and that the mystery company has the resources to pull it off. The report did not name the firm potentially interested in buying Intel, but we've been, this is kind of, I think, been out there. What do you want to say?
I just like the name of the news service, semi-accurate.
Anyway.
By the way, can we just swap Intel for TikTok or something? Can that be done?
No, not yet.
Okay.
Stand by.
I'm a solutions guy.
Stay tuned, as the president-elect said.
Ain't over yet. All right, let's go to Tesla, also a top gainer. We saw this name among the top gainers, I should say, in the NASDAQ 100 today, up about 4% off its highs. It really was about a mega cap move that we saw in a big way in today's session. Tesla, a standout today. Maybe it has to do with the upcoming inauguration, but I will say this has just been a trend that we've seen since the election. Tesla shares, guys, are up around 74% since the election, despite still being down about 9% since its December 17th high, and just another kind of standout day for that company. And then this one I heard you, Alex, talk about, I think either on TV or on radio earlier. Schlumberger up about 7% in today's session. It's the world's largest oil services provider, gaining after the company said it plans to boost total returns to shareholders 21% this year to at least $4 billion as it gears up for rising energy demand from AI.
Yeah. They're going to say SLB. I'm saying it. It's SLB, so then they can't email me and tell me.
Wait.
Send all complaints to Carol Massey.
They changed their name to SLB.
Yes.
Yeah, but it's a whole thing, so it doesn't show up on the chart.
I heard you saying this earlier, and then I went to the Bloomberg, and I'm like, it still says Schlumberger. No, just kidding.
It's SLB. They're changing it to be more of like a digital oil company, basically, instead of just like a straight-up driller that you would think of as Schlumberger.
Yeah. Isn't that just Bitcoin?
No, it's AI. It's like how they're going to use AI and digital to help their clients at the end of the day, rather than here's oil out of the ground.
Isn't it still, though?
Yes.
Oil services?
It's the same. It's just a restructuring. It's a technical SLB.
SLB. All right, take it away, Tim.
Okay. I want to start with ADRs of Novo Nordisk. They closed lower by 5.3% today. Actually, the stock closed lower by 4.3% in Denmark. We found out early today that Ozempic and Wegovy are becoming part of the latest drugs to be targeted under U.S. legislation, specifically under Medicare Part D, and they were selected for price negotiation. JP Morgan estimates that already assume 50% net price cut for Ozempic. Concerns from shareholders certainly there. ADRs of Novo Nordisk have fallen more than 45% since reaching that record high last June. Concerns about pricing, increasing competition, hurt by too much supply. We've talked about this. In fact, today, LVMH has regained the title of Europe's most valuable stock after the latest decline from Novo Nordisk. JB Hunt shares finished the day down by 7.4%. The company's fourth quarter earnings trailed expectations. They warned about first quarter results as well as cost pressures in 2025. We also saw pressure on shares of some of the trucking peers. And this is a special one for Romain. Crocs down 2.6%. I know it's your shoe of choice. There was a downgrade. No. Williams Trading downgraded the shoe company to hold from buy, saying that the outlook for Crocs and Hey Dude, owned by Crocs as well, has dimmed since that December. Fashion Footwear Association of New York. They've done these proprietary channel checks. They say retailers in the U.S. are likely at best planning the Crocs 2025 business.
This is concerning, Tim, because as you know, I just sort of started down the road of ugly shoes. I got Birkenstocks last year. My son got me Uggs for Christmas this year. I was ready to make the transition to Crocs. Am I too late?
You might be too
You're
late.
The top, man.
Hoka should be on your list as well.
But if you got Uggs, like now it's a sell. He's a contrarian indicator, basically, at the end of the day. All right, I'm going to the bond market here, guys.
Wait, did he buy the platform Uggs, Alex? Did he?
I don't know. His son bought them, so they probably are actually cool Uggs. But
can I just tell you, they They are kind of comfortable.
I want
They are comfortable, and they're warm and fuzzy, and you're going to like it next week when it's 4 degrees. All right, let's go to the bond market, guys. You saw a little bit of selling in the front end, not that much happening in the long end. I mean, the calls, though, guys, we're hearing it. Nomura, T. Rowe Price talking now at 6% on the 10-year. It's just a matter of how fast we get higher, basically.
All right, guys, let's get to some of the stories that caught our attention, some fun ones. This has to do with the Home Alone house in Chicago. We've all seen the movie. We all love the house. It's such a great little movie. Sold for $5.5 million. And, Tim, that was above its asking price.
Yeah, I'm just looking up the weather in Winnetka, Illinois. It's actually not that cold yet. It's going to be cold there. 48 degrees right now. $5.5 million, 671 Lincoln Avenue. It's a North Shore suburb, the affluent suburb. It went in under contract within a week of its listing. The owners had sought $5.2 million. They got multiple offers up the price.
Of course they would. It's Winnetka. It's Winnetka, by the way.
That's what I said, Winnetka.
But yeah, it's kind of interesting though too. I mean, we talk about the value. I mean, do you think people bought it because of the value of it being used in the movie, or is it just a great home?
Kevin McAllister is not included with the home.
And what happens? Do you have to clean up all the booby traps and stuff before you can move in?
Comes with the booby traps.
I mean, I just don't know how that works.
I think Macaulay Culkin even joked about potentially buying it last year in the New York Times.
Yeah. Can I just say, though, too, I mean, as a Chicago native, there's some great houses that have been featured in movies, largely because of John Hughes and all the movies that he filmed out in the northern suburbs there. So, and a few of them aren't actually that expensive here, probably cheaper than a New York City apartment.
Would a Christmas vacation home be included in that?
Yeah, why not?
Are you thinking about this? You're looking for a house.
I know. Look, Tim's interested. You have plans to move? Have you talked to your family about this?
Does the wife know?
You, Roman, you.
That gets at this idea, though, too. I mean, we talk about, kind of these trophy properties and why people would buy them. I think our story also pointed out you got, Michael Jordan's estate has sat on the market for forever before it finally sold because it was so unique. It was so unique to Michael Jordan himself. I think the Home Alone house was just a little bit more of a plain, regular house that just happened to have a star in a movie.
Which is the whole point, I think, of the house. Like, hey, it's your regular house, but it was also used in this event.
You still got to deal with the looky-loos, right? Who are going to come by and, peer into the windows.
Speaking of which, did you hear about that guy who owns the brownstone in New York that was used in Sex and the City?
Yeah.
And everyone's sitting on his stoop?
They got permission, a rare piece of permission to actually put up some fencing there. Because everybody hangs out on the stoop all the time.
Stop doing that, people.
I'm sorry.
I love to do that. I'm just going to put that out there. All right. Can't wait to see Romaine and the Uggs. All right, we got to go. Cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Guys, have a good and safe weekend. Stay
I said
warm.
Winnetka.
We'll see you tomorrow. No, we'll see you on Tuesday. We'll see you on Monday.
Our coverage continues here on Bloomberg Television. A big week ahead with the U.S. inauguration and the World Economic Forum in Davos starting. A conversation up ahead. Dan Tannebaum, partner over at Oliver Wyman. Stick with us. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick.
And I'm Jess Minton.
We take a look at where the markets ended the day and on the week. We talk about 2 straight weeks of declines for the S&P. That broke today here with the S&P 500 up 1% and more importantly up on a weekly basis as well. Big tech led the charge on the day. But on a weekly basis, Jess, big tech was nowhere to be found. It was financials, it was materials, it was energy stocks.
That's right. And especially when you're looking at the equal weight index having its best week since the election week back in November. So obviously you're seeing that broadening out, Romaine. And then especially wanted to point out what's happening with Intel best session since actually August. So actually jumping on a report that is an acquisition target. And just for a reminder, got kicked out of the Dow just a few months ago and replaced by NVIDIA. Of course, another one we're watching, Schlumberger. So the world's largest oil field services provider here. You're seeing that actually moving higher on the day there, but actually talked about boosting its total returns to shareholders by over 20% this year. And of course, JB Hunt, JBHT is the ticker symbol on this. One of the worst performers in the S&P 500 today, posted fourth quarter earnings that unfortunately trailed expectations.
Well, we start with our big story of the day, and that actually is the story of next week, the New World Order, a reshaping of the post-World War II standards following the biggest year for elections in human history. Half of the global population, 3.7 billion people, had the opportunity to go to the polls in at least 70 countries last year, and the candidates they chose spoke volumes, none more so than right here in the U.S. So as power players flock to Washington on Monday for Donald Trump's inauguration and to the World Economic Forum kicking off in Davos, companies and investors are girding for an environment of multifaceted regulations, inconsistent government policies, and increased geopolitical uncertainty that will test C-suite executives, Wall Street trading models, and legal and compliance teams across the corporate spectrum. That means finding strategies to minimize tariff risk, better due diligence to contend with widening sanctions, more resources to manage supply chain risk, and stronger tech to guard against cyber attacks. Over the next hour, we're going to try to provide some clarity amid that uncertainty. Conversations ahead with former British Secret Intelligence Service officer Nigel Inkster on U.S.-China relations, the founder of Bloom Nutrition on the future of social media, and Oliver Wyman partner Daniel Tannebaum on Russia and Iranian sanctions.
Let's go right to Daniel Tannebaum now. He's a partner at Oliver Wyman and the senior fellow at the Atlantic Council. And so you will be at Davos next week. Talk to us about what you think are the most pressing issues, especially when Romain just went through this laundry list of what's coming up.
That was quite a laundry list, too. I think there's a lot of anticipation of, we've seen a lot of rhetoric since the election in the U.S. What is President-elect, soon-to-be President Trump, going to make good on, and how will other countries react? We've seen a lot of talk of tariffs and retaliatory tariffs, and really the only loser in this is the consumer, who ends up having to foot the bill for ultimately these additional taxes that come forward. But I think there's a lot of cautious optimism. People are excited about a deal-friendly U.S. administration, but a lot of the measures that this team is talking about doing give people and businesses some pause of how they're actually going to make good on these promises.
And especially because Joe Biden, in his last days of his presidency, they've gone through a flurry of different things they're going to pass through, obviously, when it comes to limiting Russia oil, as well as when you're thinking about the chip making on the China front of that. How much from a negotiating tactic with the new administration on the Trump side coming in, does that give them some sort of leverage?
Well, again, the upside, I suppose, for those who were on the receiving end of this negotiation is they had a Trump 1.0. So people do have a certain sense of what they're dealing with. I think the sanctions and tariff and export controls that have been talked of are certainly just that. They're being used as a negotiating strategy, as a stick. The problem is other countries had learned from the U.S. in the 4 years of the prior Trump term and are doing the same things to U.S. consumers and interests. So there is a balance and a certain concern and caution that the incoming Trump team needs to look at to make sure that there aren't some unintended consequences of the measures that they're looking to put forth.
I do want to, Daniel, we talk about the sanctions on Russia specifically, and we're coming up not too far away from the third anniversary of this war that is still going on. We've seen a lot of countries and companies, for that matter, find ways around these sanctions to get their hands on chips, to get their hands on oil and other resources here. Is that just sort of, has that made sanctions almost moot?
Well, no, I think the challenge, and it's a blessing and a curse that this Biden administration had been very focused on the unintended consequences, minimizing broader economic shock as a result of these actions. So a lot of third countries, India, China, Turkey, UAE, Saudi, had done a lot of trade still with Russia and with the U.S. and the broader Western coalition. There are measures that President Biden actually put in place last year called secondary sanctions that can force foreign countries to choose between those imposing sanctions or those that are the targets. They haven't been used as aggressively. There's certainly a window for the Trump team to come in and use them much more aggressively to try and force countries to basically abandon Russia as a trading partner.
One thing that we've heard from CEOs on this program, as well as Wall Street investors as well, is there a concern about the more of the potential erratic nature of how these sanctions go out? The idea that for the past 4 years, Biden kind of hewed to the kind of, I guess, normal Washington playbook, if you will. And of course, we have a new president coming in who has made it clear he doesn't really care about your old school Washington playbook.
Your words, not mine. I think the important thing to note, that focus on unintended consequences is important. An anecdote from 2018, when a large Russian oligarch was sanctioned, the U.S. briefly destabilized the world's aluminum market because it wasn't clear on what this individual actually owned. And that only lasted for 2 weeks in a very narrow subset. But some of these broadband tariffs we're talking about are really significant. So what is the shock? My team is actually writing a paper with the World Economic Forum, dropping on Thursday, proposing guardrails, essentially, for those that are imposing economic statecraft measures. But there has to be some caution taken because of the interconnected nature of the global economy.
But when I hear the word guardrails, does that sort of water it down?
I think it's really to try and make sure that you're thinking around the corner, that there's unintended consequences factored in, that there aren't some economies that are disproportionately hurt, and that there's a real think through of what is being done for what the knock-on effect could be.
And something important that actually happened earlier this week, the Treasury Department said it's expanding the web of sanctions on companies and institutions supporting Russia's war efforts in Ukraine. When it comes to trying to step up some of those sanctions, and especially when you're thinking about the threat of more sanctions on businesses that are partnering with Russia, what's your view on that?
So I'm one that believes that the stick works, and sanctions are only as effective enforcement. The package that was dropped last Friday morning, there were third country actors that were sanctioned for doing business with Russia, doing business with the West, but they weren't that well known. When you think about Iran sanctions from a number of years ago, the large global banks were terrified of going back into Iran even after the JCPOA was enacted because they didn't want to be on the wrong side of the U.S. There aren't a lot of examples to point to of mess around and find out companies if they're violating sanctions. This is what could happen to you.
So I do want to talk about Davos itself and sort of what it means for the global, because Davos was sort of representative of kind of that old school kind of post-World War II globalization. When President Trump was in office the first time around, he kind of made it clear his kind of distaste for it. I know he's going to appear next week, although by video and not actually physically there. Is there sort of a role for that kind of Davos globalized elite? Or has that been upended by all of these elections we had this year that seem to almost rebuke that old model?
So it's my first year, so I'm not going to qualify myself as Davos elite yet. But I do think it's important to note that regardless of the distaste for the folks that attend Davos and what it represents, I think if COVID and other supply chain issues of the last few years have proven anything, is that globalization is still very much here, that decoupling can't truly happen. And so for global businesses to find ways to work together, to innovate, to move economies forward is pretty critical, even if some people don't like the looks of what actually is going on in that ski village.
Well, we have just less than a minute left, but I have to ask, who, especially since this is your first year, who's the top person you want to ask a question to, and what would that question be?
I honestly haven't thought about that at all. I think realistically, talking to a lot of my non-U.S. clients and getting there post-inauguration to really see what the vibe is on the ground, that's what I'm really interested to see, because there's been a lot of talk over the last few weeks.
Yeah.
Now he'll be in office, and what executive orders roll out in the first few hours.
All right, Daniel. Well, good luck over there in Davos. It'll be interesting to get your perspective when you come back. Daniel Tannebaum, partner over at Oliver Wyman and senior fellow at the Atlantic Council. He mentioned the word decoupling. Our next guest wrote a book on just that, The Great Decoupling, China, America, and the Struggle for Technological Supremacy. Nigel Inkster, he's a senior advisor to the International Institute for Strategic Studies and director for geopolitics and intelligence at Enodo Economics. More importantly, though, he served more than 30 years in the British intelligence. He has been in the room with Xi Jinping. He's been in the room with Vladimir Putin, and he shared his thoughts on the state of China and U.S. relations. Let's take a listen.
We've seen a lot of countries, particularly some of the stronger authoritarian ones, China, Russia, but also quite a lot of countries in what we call the global south, the developing world, if you like, but many of them actually quite consequential middle powers, increasingly dissatisfied with what they perceive to be the limitations on their freedom for maneuver of the post-World War II global order. And, this is manifesting itself, as you said, in elections that are ejecting incumbents who have largely been wedded to the status quo and bringing in, if one might use the term, insurgents looking to change things. We've seen this already with Russia in terms of trying to revisit the borders of the former Soviet Union. We've seen China promoting a very different alternative to the US-led world order. And now we're seeing America apparently challenging some of the fundamental concepts of that order, in particular the inviolability of post-World War II borders.
Well, let's talk, Nigel, for a second about two of those, particularly the U.S. and China. And I want to start with China because during your time in the British intelligence service, you spent the bulk of that career in China, inside China's borders. And you had a chance to really see the growth of that country from basically a small kind of backwater economy to the global power that it is today. Did that seem inevitable to you when you were there, or have the changes that they've made in recent years been the primary driver?
I always thought that even when China was at its lowest ebb, right at the end of the Cultural Revolution, the first time I went to China, that there was enormous potential there, and that sooner or later China was going to be a country of real consequence again, because for most of recorded history it was, in effect, a global superpower. But I think everybody, including myself, was surprised by the speed with which this happened. In fact, many Chinese themselves were surprised by the speed at which it happened. And obviously, modern technology had played a critical catalytic role in enabling this process to happen so fast. So no, I think it was always likely that China would emerge as a major global player, and now this is the case.
But do you think there will be, I guess, a mutually beneficial relationship between a Donald Trump-led United States and presumably a Xi Jinping-led China for the foreseeable future?
Well, it'd be very nice to think that that might be possible, but I actually believe it's going to be very difficult to achieve that, simply because the differences between the United States and China are deep and structural. They're about ideology, they're about values, but they're also about raw geopolitical power. Now, if the United States, for example, were ready to change its dispositions in the Western Pacific and be ready to, so to speak, cede ground there to China, then it's not inconceivable that we could end up with a kind of latter-day Treaty of Tordesillas, the agreement at the end of the 15th century brokered by the Pope that divided the world between Spain and Portugal. And it's not totally inconceivable that one might see something comparable.
So that kind of brings me to my final question, Nigel, and it's about what other country out there can actually benefit from this type of disruption. We focus a lot on the U.S. and China because they are the two major economies. But is there another nation out there that we could potentially see bubble up primarily because of this rift?
Yes, there are. I think there are a lot of so-called middle powers who are quite economically developed. I'm thinking about the Gulf states, I'm thinking about Saudi Arabia, I'm thinking about Turkey, that have got quite a lot of resources, quite a lot of ambition, and feel less constrained than they previously had been, and are now pursuing their own agendas and their own ambitions with greater confidence. So I think we're going to see a lot of these middle powers. I also would obviously highlight India as a country that in the long term potentially could become a competitor to China, but I think has some way to go economically and technologically before it might reach that point. So we're looking at a world which is kind of moving back to what it looked like before World War II.
Nigel Inkster there, senior advisor to the International Institute for Strategic Studies. I spoke with him earlier today. He spent a lifetime in the British Secret Service, Jess, and a guy who really understands not only the lay of the land, but he understands the characters involved. And a big part of his job, too, while he was in the Secret Service, and of course, once he came out, was also a big focus on cybersecurity.
And that's really important because on the back of the last few days that Biden is remaining president, he issued an executive order earlier this week with basically is supposed to strengthen what we can do when it comes to cybersecurity and also making it easier to go after foreign adversaries as well as hacking groups.
Well, that's what I found so fascinating. When I first met him last year for the first time, he kind of started his career in like the old school spy days, the cloak and dagger days. He actually said, You can't even do that nowadays.
Right.
It just doesn't translate. Everything is done behind a computer screen to some extent or another.
The way that technology has evolved, and especially the way that the government is trying to combat this at this point.
Yeah, so it'll be interesting. We talk about this idea of can Xi Jinping and Donald Trump sort of repair that relationship, that U.S. relationship. They apparently spoke earlier today.
They had a phone call.
Interesting
Trump said
readout.
it went well.
There's going to be a lot of, course, discussions about his relationship with Vladimir Putin, whether we welcome him back onto the world stage. A lot of questions, and questions that are political in nature, but of course are going to have real live implications for the markets.
And we know how quickly those things can change. Even covering the trade war before the pandemic, there was so much back and forth between Beijing as well as Washington.
All right, well, we focus a little bit here on the geopolitical implications of the Trump presidency. We're going to continue to talk about that presidency, but maybe focus just a little bit more on what's going to actually happen here within our own borders. Coming up after the break, a sit down with Ed Mills. He's a Washington policy analyst and a managing director over at Raymond James. You don't want to miss that conversation. Stick around. This is The Close on Bloomberg. We're on the eve of a new administration here in the United States. President-elect Donald Trump's inauguration is on Monday. It's actually set to be one of the coldest on record. In fact, officials are now saying that it's actually going to be moved indoors. But despite, well, maybe the less pomp and circumstance around the inauguration, Trump has already made it clear he plans to hit the ground running. Several nominations for key cabinet positions have already been announced. They've already had their hearings as well. He's already announced several agencies and advisory boards that he plans to implement, signaling key changes about how his White House and this country will be run. Ed Mills is a Washington policy analyst and managing director over at Raymond James. And let's start off first, Ed, with some of those cabinet picks. Most of the hearings that we had this week actually went a lot smoothly, more smoothly than I thought, particularly with some of the more controversial ones, like Pete Hegseth. Do you think that all of the cabinet nominations that Trump has put out there are going to make it into their offices sometime next week?
Roman, I'm not sure if every one of them is going to make it into the cabinet or get their confirmation, but the vast majority will. What you noticed this week, as you highlighted, is that these confirmation hearings had a lot of support by Republicans for the nominations. Democrats certainly sought to disrupt that process, but because of the change to the confirmation process that dates back to the Obama administration, you only need a simple majority. Republicans have 54 senators. They will have the votes to confirm most, if not all, of these nominees, and they will take a little bit of time to get into place. But day one, we're probably going to see Marco Rubio as the first cabinet secretary, as Secretary of State, into the cabinet.
It's kind of interesting. There are two interesting stories on the Bloomberg terminal today. One, the headline, Trump faces blunted Democratic resistance as his second term starts. And the other was about the founder of that women's march that we saw back during the first Trump administration, who basically kind of shrugged her shoulders and she's like, I'm not doing anything this time. And I do wonder about how the landscape has changed in Washington. There does not seem to be that level of outrage and resistance that maybe we saw in 2016 and in early 2017.
Yeah, and we're 8 years into this. So when he won in 2016, I think it was exceptionally unexpected, and there was a desire to show, especially with Democrats who, Hillary Clinton had won the national popular vote, a building up of that resistance. One of the big debates here in D.C. is Donald Trump won the national popular vote here in 2024, but what is the best way to push back against him? Whenever you push back against Donald Trump, his counterpunch is much harder, to the extent that you get into a fight. Are you able to win? That's a question that Democrats are asking. They certainly are not going to kind of go lightly, but I think they are kind of keeping their kind of opposition a little bit kind of restrained to start, to try to identify the fights that they think are necessary to really draw the distinction between Democrats and Republicans and Democrats and the Trump administration. But the reality is, it is a Republican president, a Republican House, and the Republican Senate. So a lot of the things that he wants to get done will get done.
Hey, Ed, you mentioned that it could take some time to get these nominees approved through Congress. During Trump's first term, it took at least 4 months for the first round. How are you viewing how long this could potentially take, if it's either months or even longer?
So, Jess, the longer this takes, the more we're going to be talking about recess appointments. I don't think we're going to get there. This is something that I think will take 2 to 3 months to get the key officials in place. Once we get this going next week, I think there will be a certain momentum behind that. One of the key differences in 2025 versus 2017 is not only is the cabinet much more fleshed out earlier, we're starting to see sub-cabinet agencies, a lot more of the conversation of who are the deputy and assistant secretaries that are going to be announced and confirmed. So it is going to take time, but it is a government put forward by Donald Trump that is more robust in the personnel earlier this time than in 2017.
Of course, how should investors consider how their expectations should be monitored around tariffs? Because as you remember, during Trump's first term, there was so much back and forth on that.
Yeah, Jess, you're absolutely right. I think a couple of things that we've told investors here at Raymond James is, number one, expect the unexpected. Number two, take Trump seriously. Don't take him literally. I spent the week in Canada this week, and every single meeting at Raymond James was, are tariffs coming? My message is, yes, tariffs are coming. The way in which I look at this is that we are going to get an announcement probably next week. I don't know if it's day one and if it's executive order one, but we're going to start the process. There is a big debate raging right now within the Trump administration. Team Econ that wants to go slow, wants to implement this over time. Team Trade wants to go fast. They want to be aggressive. And one of the big differences, I guess I'd say finally, Jess, here, is that in Trump 1.0, tariffs were shocking and they were about unfair trade practices, especially with China.
Yeah.
In Trump 2.0, we have that, but we also have this idea that they could collect revenue with the External Revenue Service, the ERS.
Yeah.
They can be used as leverage to change policy.
Yeah.
So it's going to be much more robust in Trump 2.0 is, I guess, what I'm trying to say.
So, Ed, as we're speaking now, we are getting headlines out of the Treasury Department. Of course, the departing Treasury Secretary Janet Yellen sounding the alarm as we play this game again on the debt ceiling, basically advising the Treasury to start extraordinary measures to avert the debt limit. She says that should start on January 21st, of course, the day after the inauguration. This is a letter being sent to Congress. Those headlines crossing the wire. A new Treasury Secretary will be in place at some point in the name of Scott Bessent, should, barring some, miraculous change in Congress. I do wonder how serious Congress, and for that matter, the White House, is about addressing some of these budget and debt ceiling issues that have really been lingering now for at least the last decade, really longer.
Yeah, Romain, we're going to extend out the debt limit. We almost did that back in December. But people weren't prepared for that. So the next catalyst I'm watching is March 14th, when we have to fund the government again. If they don't do that, it's probably getting closer to the X date before we extend it out. And it's going to be done on a bipartisan basis. When you look at the Republican majority in the House, it's so small. And there's a handful of Republicans that will never vote for an extension of the debt limit. Democrats will vote in favor of that, especially if we get a budget deal that's struck on government spending that includes maybe some disaster relief. In addition to that, I think longer term, I think we have had a focus on DOGE, the Department of Government Efficiency, and a push to maybe have $2 trillion of cuts.
Yeah.
My bet is at the end of the year this year, we will be spending more than we did last year.
All right, Ed, thanks so much for being with us. That's Ed Mills, Washington policy analyst at Raymond James. And of course, Romain, let's get a little check here on the cross-asset movement now that we're after the closing bell. And of course, I have to start off with the bond market because of the big move that we did see in bonds bond yields this week. You're looking at the 10-year Treasury yield around 4.62 here after it was around 4.80 earlier this week. Obviously, that coming off the back of the cooler than expected CPI report in the middle of the week here. So obviously seeing a big basis point drop there. And of course, in relation to stocks, that's why you're seeing a big move to the upside at the end there of this week. And of course, another one I'm keeping a close eye on, as well as Gina Martin Adams over at Bloomberg Intelligence, is the Bloomberg Dollar Spot Index, because we are in the midst of things are about to ramp up with earnings season. So keeping a close eye on the U.S. dollar and how it's been performing. Slightly higher for the day, but still sort of flat for the week. But actually, if you look back since how it's performed since the end of September, it's up over 7%. High beta stocks relative to the dollar have still been outperforming since that span. So not surprisingly, it's stocks like Nvidia, Tesla, Alphabet still doing well. But Gina Martin Adams was saying that she's keeping a close eye on those just to see that if the dollar continues to strengthen, what that could potentially mean, and if that correlation still sticks with what they're doing as well. Yeah, and then you take a look there at Bitcoin back above that 100,000 level, closing out right around 105 here on this Friday. A lot more coming up on the big program, including the discussion about TikTok and social media, including a discussion about how one wellness brand used social media to make nutrition go viral. You don't want to miss it. Greg LaVecchia, CEO and co-founder of Bloom. This is Bloomberg. You know, we started off the close today talking about that Supreme Court ruling on TikTok, and we talked about it from the legal angle and, of course, from the investor angle, but we kind of forget this has big ramifications for the more than 170 million U.S. users, many of whom actually make a daily living from the platform. So it's kind of a great coincidence today that we have a company like Bloom Nutrition on the program who are able to utilize the virality of TikTok and other social media to build a health and wellness juggernaut. And it is a juggernaut. Now it's expanding its retail presence at stores like Target, like GNC, like Walmart, and like Wegmans. I'm pleased to say joining us here in studio is Greg LaVecchia. He's the CEO and co-founder of Bloom Nutrition. Great to have you, Greg.
Thank you for having me.
All right, a big fan of yours. And I am curious just to how you build a brand. You know, I kind of am old enough where, I come from kind of that generation where building a brand was really hard. I mean, you had to have the right connections. You had to kind of know the right people. And social media just really changed the landscape. So just kind of explain how you were able to do it.
Absolutely. So my co-founder and my lovely wife, Mari Llewellyn, she went through a fitness journey, and in 2019, we launched Bloom Nutrition, starting with workout supplements for women who were lifting weights, who were very much her following on Instagram at the time. And we started with pre-workouts, recovery powders, protein powders, and we were addressing her following amazing community, which were women who lift weights. And then Mari was looking for an all-in-one gut health formula, and we launched this all-in-one greens and superfoods powder. We realized overnight that our niche market went to any woman in the United States market, and we realized the best way to go reach all of the consumers to discover this product was creating an influencer program. So instead of reaching out to every agency we could find, we decided to build that in-house. And we started just calling, emailing, texting, direct messaging on social media, every influencer that we could find that would like to partner with Bloom Nutrition. And we built what is probably without a doubt the largest in-house influencer agency in a CPG company that we've been able to scale to, some months getting over 1 billion views, several Super Bowl ads worth of views every month to create awareness of this product. And we've been able to use that digital awareness to drive omni-channel retail conversions for our strategic retail partners like Target and everyone you mentioned.
What was the biggest challenge in that process?
Just, we started this business out of college. So we did not have any formal suits in the room with us or anyone with experience in the room. All we knew was social media. Mari had such an eye for how to communicate to her community and work with other influencers to communicate about our brand. So the biggest challenge was probably just creating the scale of communication to the amount of people that we wanted to speak on our product.
So how do you expect to mitigate certain issues when you're thinking about the implications of what could happen with TikTok in relation to when you're trying to deal with advertising and then obviously grow your users?
Yeah, so of course we started with Instagram. Most of our influencer marketing moved over to TikTok probably in 2021, 2022. And you know, the eyes are going to go somewhere. The influencers and the content creators are going to go somewhere. And if TikTok is not saved, then we'll of course have to, pivot and go over to YouTube, Instagram, Snapchat, whatever it may be. But the show must go on, and the message must continue to get spread.
Of course, since it is January, especially coming off of the holidays, just asking for a friend when it comes to maybe, indulging in certain sweets like that. But I know that your company is trying to go further out into things like energy drinks, other space. Talk to us more about that, who people are trying to think about January and doing the whole new year's resolutions.
The energy drink has been so exciting because it provides the performance value that people want in a supplement, but you're replacing it with that yummy beverage that you would be having anyway. So it's a supplement while being a functional beverage, and we've been able to again use that, disrupt this legacy category through this digital presence and help everyone with their fitness goals to be as energized as possible through January. And energy is the first step to getting something done, right?
Yeah, absolutely. Talk about the production and manufacturing, because I've spoken with a lot of entrepreneurs, and they always go through these growing pains where they're selling a few dozen or a few hundred things a week to all of a sudden selling several thousand. It's almost like, oh my God, I need a real factory and real production facilities. What was that scale up like for you? I mean, you're doing what, like 100,000 or so units a month, or
more. So
okay.
we manufactured tens of billions of cans for 2025. Probably we'll run through those in just Q1. We bootstrapped this brand through January of 2024. We partnered with Nutrabolt out of Austin, Texas, and they're partnered with Keurig Dr. Pepper. So we are able to distribute this drink across the United States using the Keurig Dr. Pepper distribution network. And it has just been going from a bootstrapped company to having the legacy wisdom to distribute this drink everywhere. It's been just a perfect pairing of our digital social knowledge with their traditional distribution logistics knowledge, and we've been manufacturing with Nutrabolt, who have top of class facilities in their network. So
there are no issues with trying to get the raw materials and other supplies. You need cans, things like that, in order to make everything.
It's never flawless, but it's been a great experience of procurement thus far.
Yeah.
It's funny because whenever I hear kind of growth and synergies, it makes me want to ask you more about your potential for eventually going public. I know you're a private company right now, and Nutrabolt about a year ago was one of the lead investors and holds a roughly 20% stake in your company.
Yeah, I think Bloom is a private company. I don't really love anyone telling us what to do. They're a minority partner of ours.
I had to go there.
but Nutrabolt seems to be ready for anything at all times, and they try to hold us to that standard as well. So I'm sure anything's possible in the future.
Let's talk about what's possible in the future too, because when we talk about establishing a brand, then the next question, particularly once if you ever do go public and you have investors breathing down your neck, it's always like sort of what's next. And I mean, what can this expand to beyond? I'm talking about beyond just your current lineup. Have you thought about different products or even different lines of businesses?
It has been incredible to watch our product portfolio expand, just as my wife being the face of the brand, Maria Llewellyn, as her life has changed. So as she, let's say we are trying to start a family right now, or as she has just aged and she's become this, serial entrepreneur having different needs for her nutrition and lifestyle, I see no reason why Bloom is not the platform brand that can have baby food, that can have a better for you beverage, that can have, of course, a multi-billion-dollar energy drink. So I think that, the name Bloom, the brand Bloom can truly, we will be taking some very large swings across the next 48 months, and we will be disrupting legacy categories with our new school tactics.
We only have a couple seconds left, but what's the main thing you want to goal for the next year?
It's energy, and I want this thing. I want it to be easier to not find this product. So we will be in all of these bodegas outside here in New York City, or I know we have a distribution network already in Alaska. So we're going everywhere.
All right, Greg. Well, you're very energetic, and obviously a product that's already gained a lot of traction. Great, and wish you the best of success. Greg LaVecchia, there, CEO and co-founder of Bloom Nutrition. As we round out the show, a good reminder here that next week is a holiday-shortened week for financial markets, but that doesn't mean it's going to be any less busier. We're going to set you up for what to watch when we come back after the break. All right, it's time now for our top three. This is where we name drop the people driving some of the day's most talked about stories, and who better to start with than Whitney Wolfe Herd, the Bumble founder, back as CEO. This after departing just about a year ago, a company that has changed a lot since she left here. The company has really been struggling, and now she's back in. LaDaine Jones, the CEO, out. for personal reasons.
That's right. And even the company right now, they're expecting their fourth quarter revenue to fall above the midpoint of its previous range. So something to keep a close eye on right here. But I wanted to point out what's happening with Goldman Sachs. Obviously, big week when it comes to bank earnings. But Goldman Sachs boosting CEO David Solomon's pay by 26% to $39 million. So this is something where Goldman's giving about $80 million, a million reason for Waldron to wait for the top job here.
I love this, too, because it also kind of buried in that was this idea that Goldman was launching this whole compensation program to give its executives sort of a slice of the carried interest on private equity deals. And there's been a lot of talk here about employee retention, particularly with the stars. I mean, obviously, you want to keep Solomon around.
That's right.
I mean, although it seemed like a couple years ago, maybe they didn't. But now they're keeping him in the fold. And the idea that all these other folks, the money makers, they want to make sure that they don't jump ship for greener pastures as well. So kind of interesting the way they rolled this out.
It's interesting how things have flipped here for Solomon, for sure.
Absolutely here. So it looks like Solomon will potentially stay put for a little bit longer here. And I'm keeping an eye on our third guest, and this is Chrystia Freeland. She's was kind of the everything person to Canadian Prime Minister Justin Trudeau. Of course, Trudeau will step aside. There will be an election. A lot of talk who's going to run for a seat. Mark Carney apparently throwing his hat in the ring, and now Chrystia Freeland herself. Of course, a lot of people know her as one of the lead trade negotiators back in the day when, let's just say, there was some friction between the U.S. and Canada.
That's right. And you're bringing up Mark Carney. Of course, the winner will become Prime Minister in March. So something to keep our eyes on very closely here.
Absolutely. Three of the folks, of course, that will be watching not only today, but quite frankly, for 2025. And that brings us actually now to what to watch over the next week. And it is going to be a busy week. This was a busy week. And we want to start off on Monday with just a quick note here that financial markets will be closed on Monday, January 20th, in observance of the Martin Luther King Day. That is normal. Of course, this also tends to happen. The inauguration every 4 years or so tends to also fall on MLK Day. That inauguration will go on. We are told that because of what is expected to be extremely cold weather in Washington, D.C., potentially in the single digits, that they will actually have that inauguration ceremony, the swearing in, indoors, not outside on the Capitol steps as is normal.
And of course, that's the first time we would see an indoors inauguration since the second term from Ronald Reagan back in 1985. But of course, moving over to Tuesday, though, Davos Day number 2 here. Also, of course, can't forget earnings, 10% of the market cap for the S&P 500 reporting. So United Airlines, but Netflix is the one that's really leading things.
Right. We talk about Netflix, D.R. Horton, United, Capital One. The whole idea here of sort of, the big companies that are really going to sort of move the markets. We got a taste of that with the banks. But of course, we broaden that out so we get a much broader view of what's going on in the economic situation. We can't forget Davos. Davos starts on Monday. On day 2, we will have interviews live here on Bloomberg. Keep an eye on that. Team Surveillance and a bunch of other folks will be out there in Switzerland. We're also expected to hear on Wednesday from ECB's Christine Lagarde as well. That is on Wednesday, January 22nd.
And of course, we'll have more earnings coming up with Johnson & Johnson as well as Procter & Gamble. So 10% of the market cap, like I mentioned, of the S&P reporting next week, Raymond.
Halliburton also scheduled to report as well. We should also point out that Trump will be making an appearance at Davos, so it will not be in person. He will address the forum virtually. Meanwhile, back to earnings. We are going to a couple interesting reads on the economy. What do you think of this, Jess? American Express and Verizon.
It's going to be important, especially when you're thinking about credit card issuers and how that's tied to the consumer, and especially more of a kind of luxury type items that the Amex customer typically buys.
We are going to get those weekly jobless claims numbers as well in the midst of all that. And then we move to Friday. Davos still going on here. More interviews from Davos, and we're actually going to get an interesting decision out of the Bank of Japan. Maybe the rates might not move the market, but of course the communication could potentially, and of course more economic data back here in the U.S.
That's right. The Bank of Japan will be important for the correlation between S&P futures and the U.S. dollar and the Japanese
We want to thank you for joining us here on The Close this week. We will be back on Tuesday for all of your markets coverage. For your political coverage, stick around. Balance of Power is up next, right here on Bloomberg.